Welcome to the Capital Spreads Weekly Update. Today is Wednesday, the 20th of April 2011. And the week so far, well, it's been a relatively mixed bag in terms of volatility. We've had periods of relative quiet volatility mixed with some quite high volatility off the back of certain economic announcements and economic results. However, the market on the whole has actually decided a clear direction in which it does want to go, and that is upwards. And that seems to be covering pretty much most of the market and asset classes. For example, the indices, the equities, the commodities, as well as the currencies against the US dollar. Some of the highlights of the last week or so include the fact that the S&P ratings agency has put the US debt, long-term debt outlook on negative watch, which means that they could potentially downgrade the US's AAA credit rating, something that would be an absolute disaster considering the amount of the debt that the US has at the moment and how much the rest of the world actually relies on the US and its cheap financing. On top of that, we also continue to have ongoing concerns about a number of the Eurozone countries, in particular Greece, and as to whether they will now actually need to restructure their debt, as to what will also happen regarding Portugal as well as Ireland going forward. In addition, we are also in the middle of the earnings season, and in particular a number of the bellwether companies, particularly in the US, have announced far better than expected results. For example, IBM and Intel have both announced results that have actually exceeded analyst expectations. As a result of that, we had a sell-off at the beginning of the week and have since had a bounce in the equity index markets as a result. So looking at the FTSE as it currently stands, it's trading around 60.30. It's up about 80 points in the day. The FTSE had a sell-off along with the rest of the equity index markets of the last few days and has bounced off the back of particularly the strong corporate earnings out of a number of the bellwether companies, as I mentioned previously. It seems to now be heading back towards the yearly highs of 61.08. However, 6100 seems to be a very strong resistance level in the FTSE, and every time it approaches that, it seems to bounce off that. Likewise, 6,000 seems to act very much as a pivotal level in the FTSE, as I mentioned in a number of my previous posts, and it finds it difficult to break out both on the upside as well as on the downside from the 6,000 level. On the upside, if it breaks above 6,100, you're possibly looking at a target of around 6,400. On the downside, if it fails to break on the upside, you're looking at support possibly around 58.30. I have an interesting chart to show you regarding the FTSE. As can be seen, it looks like the FTSE has been in very much a strong uptrend since the lows of March 2009, and that uptrend hasn't actually been broken. If anything, since July 2010, that trend seems to have actually accelerated on the upside. That trend certainly seems to be intact, and if anything, you'd possibly expect it to go higher from here. Eurodollar has also become quite topical recently, firstly because of the fact that the European Central Bank was the first Western major central bank to actually raise interest rates, and the fact that Jean-Claude Trichet, the governor of the European Central Bank, has hinted that there could possibly be further interest rate rises in the Eurozone. How that will actually impact the peripheral countries that are actually struggling at the moment, obviously it would be negative. However, the overall view seems to be that the Eurozone on the whole seems to be doing quite well, and the rate rises are justified. So as a result of that, we see Eurodollar continue to strengthen. It's now near yearly highs of 145.00. It hit a resistance level around 145.60. If it breaks above 145.60, you're possibly looking at a target around 148.00. However, on the downside, if it fails to continue higher from here, you're looking at support possibly around 141.80. The commodity markets, along with many of the other markets, seem to be rallying recently. However, they seem to be rallying off different news. For example, gold at the moment seems to be rallying off the fact that it's acting as a safe haven because the US might get downgraded and because inflation still seems stubbornly high. The soft commodities, for example, wheat, seem to be rallying off the fact that we might have a possibly dry summer, which will curb the amount of crops being produced. And you also have rallies in oil, for example, off the back of the Libyan war, which seems to be ongoing, and there doesn't seem to be any end to that. And the fact that if the global recovery maintains pace, then there will be an increasing demand for oil from a number of the global economies, including China. In terms of the week going forward, I would say there are the figures on the whole seem to be relatively quiet. However, there are two figures that you might possibly want to keep an eye out for. The first will be the UK retail sales, which come out tomorrow. Now, the UK retail sector forms a large portion of the UK economy, so any deviation from what can be expected will certainly move the markets. We're actually expecting a small fall in UK retail sales, which will actually indicate that the UK economy is still in a fragile state of recovery at the moment. Other than that, on next Tuesday you'll have the US consumer confidence come out. We're expecting a slightly better figure at 64.5. Now, if that is the case, again it will provide further impetus for the equity index markets to continue going higher. In terms of client activity, many of our clients have actually faded the markets at their current levels, believing that the moves are overdone and we could possibly see a retracement. So unexpectedly they're short the indices markets, the Dow, the S&P, the FTSE and the DAX. They're also short gold, however they are long silver. They are also short oil, believing that the oil rally that we had the last few days or so is actually possibly overdone and maybe due a correction. In terms of the theme of the week, I would say the theme of the week would be the fact that the positive market sentiment certainly seems to be intact, and despite the negative economic warnings out of a number of credit rating agencies and the fact that the Eurozone crisis and the concerns haven't gone away, other factors seem to be supporting the fact that on the whole the global recovery is certainly on track and could actually get better. That's it for now. As usual, if you have any feedback, it's media@capitalspreads.com.